So I recently met with someone who is interested in a whole life insurance policy. Cash value is his goal. He's got an interest in borrowing against the policy and such. However, with respect to the funding, he described a situation. It went a little bit like this. Right now, Steve, I know I can fund the policy anywhere between $1,000 and $2,000 per month. However, my wife and I own a real estate business. There are times where we come into large lump sums of money. I like the idea of being able to throw more money into the policy, but I don't know how often or even if that is going to occur. In the past, we have had lump sums. I feel that it will happen again, but I don't want to set up a policy and feel obligated or be committed to add large lump sums into the policy. So his situation, he knows he can commit to a certain dollar amount, but he wants the policy designed in a manner where he's got the ability to add more money, but he's not obligated or not committed to doing that. Is that possible? Yes. In fact, most people we work with will do exactly that. I want the ability to add a lot of money, but I only want to be billed for a small amount. The minimum amount actually is what I would really like, and that's typically what we do. So to provide some details on his situation, we're going to go through exactly what I just mentioned. I'll show you how we set the policy up and then how we can fund it. He's ready to start a policy, but he would like some guidance, some details on him. He's presently 40 years old. Company selection. In this particular case, we looked at Guardian only. In the initial stages, personally, I'm a fan of looking at more than just one company and product. However, in his particular situation and the first phone call we had, just talking about the flexibility and really getting some information on his business where he said that flexibility is really nice, where I can just throw lump sums in up to $100,000 per year. I'm interested in that, Steve. Sticking with the major mutual companies in order to maintain top tier quality with respect to an insurance carrier selection. Guardian's one of them, but then they also offer a lot of PUA flexibility. So what we're going to look at in today's video is a product with Guardian and a couple different funding options. Regarding the funding, the minimum commitment here, or the minimum, $12,000 per year, or $1,000 per month. He mentioned funding amounts of anywhere between $1,000 and $2,000 per month. That's what he knows he can do right now. But then, see a maximum funding amount of $100,000. Meaning I know I can do this, but what's it look like if I go up to this dollar amount? Or perhaps lower amounts? What if I add lump sums of $24,000, $50,000, somewhere in between? It's beneficial to see that, especially if you're unsure if you can hit that maximum dollar amount. Number of years, unknown at this point. So what we put together are a couple different scenarios, again with the same product, so we can see different what-if scenarios as opposed to being surprised after the fact. Surprise, I didn't know it was going to look like this. Like, no, we don't want that. What we'll look at here is funding periods anywhere from 5 years to 25 years. And where I came up with 25 years is that it takes him up until age 65. And he did talk about saving in other areas such as IRAs and such for his business that he and his wife own. So they're looking at areas to position money right now. So the 65 just gives you a typical retirement age. They don't have to fund it that long, but that's where I came up with the initial scenarios, and we can make adjustments there. His area of interest with the policy is using it for his real estate business. Specifically, they're in the renovation business. What he's interested in here is using the cash value as a personal line of credit, again, for his company. Once the cash value is built up to a large amount, he can then go to his policy for financing needs instead of banks or lenders, which gives him a lot more control. That's very appealing to him. So some funding details, because this is the most important part here. If we don't get this right, everything else falls apart, or it's not optimal. This is where people have buyer's remorse if the initial design is not set up correctly. So what we're going to look at is the same policy here, but different funding options. So A, B, C, and D, all the exact same policy. The purpose here, or what these are going to illustrate, is what does the cash value look like if you fund A, just the minimum of $12,000 per year. B, you mentioned between $1,000 and $2,000 per month. $2,000 per month times 12 months is $24,000 per year. That's where we came up with option B. And then C, what's it look like if you fund a total of $50,000 per year? And then D, what's it look like if you max fund it at $100,000 per year? And in my experience with situations like this, where someone wants a large range, I want to commit to $1,000 a month and be able to go up to 100K, usually the funding varies. You'll see them set it up with $1,000 per month, or they'll pay $12K a year if they fund that annually. And then over the course of each year, they're adding more funds into PUAs. Some years they may add nothing extra. Other years it might be 50, then 100,000. The funding can vary as the years pass. What I like to put together in terms of initial illustrations are round numbers because it's easier to follow. Simple math is what we look at here. Helps me at least. Points to consider. Is $100,000 realistic? So he did mention that he would like to have a maximum of 100K. My question here specifically is that realistic? And specifically, do you feel that you'd be able to get $100,000 into the policy for more than just 1 year? Could you foresee yourself potentially getting 100 grand into the policy 2 years throughout the life of the policy? So from the day you start forever, during any 2 policy years, do you think you could get 100K in? Because if the answer is yes, then it'll likely be worth going with that 100K option where you can fund it very aggressively. If you're able to redline a policy, meaning 10x the base premium and fund up to the MEC limit for 2 years, you typically see strong results with respect to the cash value as a result. However, if it is not realistic, if the response is no, or I don't know, and I really don't want to bite off more than I can chew, what I would consider is this. What about policies where you have a $24,000 or $50,000 maximum? Is that more realistic? And a $24,000 maximum, what that would mean is that your minimum does not need to be $1,000 per month. It can be about $200 per month, $2,400 a year. And then you've got the ability to go up to a maximum of $24,000 per year. Because remember, if we set it up correctly, we can 10x our minimum. So that's very nice from a flexibility standpoint. So I would ask that question. Maybe you want to start out low, be able to maximize the policy for several years, really see the value. And then once you are comfortable with the product, then perhaps in the future, when your business is really cash flowing, then you consider a larger policy. That's an option as well. You can do the same thing with a minimum of about $5,000 here if you want the 50K max. But I do want to ask that question and talk through it because while cash value life insurance is great, and yes, if you have a large policy and you're able to heavily fund it, it looks really, really good concerning the numbers. We don't want to bite off more than we can chew because that's where we can really see it underperform. So let's take a look here. We'll look at option A first, an illustration of option A, and then we'll look at the same illustration, but with option D. What do you notice here? Down here, you'll see $12,000 per year going in. The question is always what? Where is my money going? Here's your premium. So his commitment is actually less than $12,000 per year. The $12,000 per year just comes from his desire of being able to commit to $1,000 per month. So his premium, $9,000 and change. Then we've got a scheduled PUA of $2,900 and change. Add those two together. Guess what you get? $12,000. Now that scheduled PUA rider does not all go toward PUAs, which help accelerate the cash value. We do have a cost of the term insurance rider here. What's the purpose of a term rider? Cost-effective way to raise the death benefit, which raises the MEC limit. So the net death benefit here, $2,050,000, which gives him a MEC limit of 100 grand. Slightly more than that. Here's the whole life death benefit. There's the term. If you don't have a term rider, it's going to force a higher base premium, which will force a higher minimum commitment. It'll also force less money showing up in cash value in the first year. This does not show up in cash value in the first year. Or a small portion of it does. There's the base premium. There's the amount that's guaranteed of the base premium to show up in cash value in year 1. But anyway, as we look at this, what does this illustration display? Because this is his policy. If he wants to go with the 100K option, where he can fund up to $100,000 per year, but not be committed to it, this is what it would look like. This is a formal illustration. Let's take a look here. $12,000 a year, up until age 65 in this particular case. What we saw, going back to the funding, is just a scheduled PUA. So look at that number, and let me know if they change. Back to it. Next one. Did those numbers change? No, they did not. The base premium and that scheduled PUA rider stayed the same. A scheduled PUA means that you're scheduling the payment the same time as your base premium. So if this is you, what you're committed to is $12,000 per year or $1,000 per month. Be a little bit higher than $1,000 a month because companies charge fees, but that's your commitment. And then what you have here is an unscheduled PUA payment. It's up to you to add those funds. But this demonstrates what the policy would look like if you do add additional funds. This is going up to $100,000 per year. So we're assuming he throws in an additional $88,000 per year for the first 5 years. Break-even point, year 5, meaning he's paid in $500,000 and he has $500,000, a little bit more, actually in cash value. So this is the kind of stuff to look at up front, where we looked at first the illustration where it was just the minimum, and then second, the illustration with additional funds going in. So let's take a look at this, which will be our illustrations side by side. On the left, what do we have? The illustration we just looked at that displays the $12,000 per year minimum. So when we look at the breakdown here in red, what do you notice? The term min prem, which is short for minimum premium. I wanted to call that minimum commitment because the true minimum can actually be a bit less. But again, that's your base premium, term rider, and then rounding up to it. The rest is going into a scheduled PUA. But here, there's no additional PUAs being added. So a nice way to look at this, how a lot of people approach it is, okay, in my mind, mentally, I'm going to schedule this dollar amount. That I know I can hit. And then when I want to dump additional funds into the policy, I can do so. So we'll call this additional PUAs, which on the illustration will be an unscheduled PUA. So here, we are only paying the minimum. And by the way, if you say, I want to start this exact policy with the ability to add more, in your formal contract, when the illustration is included, it'll look like this. So that last illustration we just looked at, you'll see that because in your contract, you're only going to see the scheduled minimum amount or however much you schedule to be billed on a regular basis. But the values change once you start pumping more money into the policy. But when we look at this, there's cash value, there's your death benefit. If you fund just the minimum, how's it look? Not that good, does it? Takes between 13 and 14 years just to break even, which is in line with a traditional whole life insurance policy. Traditional whole life is a policy where I buy a death benefit, I pay a premium. The premium does not show up in cash value in the first year. As I continue to make premium payments, I see those premium dollars show up in cash value. But here it takes a long time when I look at my total payments before I actually see a positive cash value. So how do I make it look better? Adding money into PUAs is the key. So let's assume he goes with the option where he can go up to 100K. He's got the 100K MEC limit. But he mentioned earlier, $1,000 to $2,000 is what I know I can do. And we have a situation where he says, I bit off more than I can chew. I was only able to get $24,000 per year total into it, meaning my scheduled minimum. Then I was able to add an additional $12,000 per year for a total annual amount, $24K per year, which is break even. Year 9 in this particular case. Now, that still is a lot better than the first example, and that will almost always be the case when you add additional funds to PUAs. But here, we've got a policy that is nowhere near optimal. It's close to a 50-50 split when you look at it, meaning 50% base and 50% PUA, with the ability to scale up your PUA payments, but that's why it's taking so long here. We're not adding enough into the policy. We're not redlining it, to use that illustration. Let's look at the exact same thing, but with 50K. And we got a little creative here too. On the left, you've got your minimum, and then to the right, you fund a total of 50K per year. So what we did in this scenario is fund an additional 38K for a total of 50 through year 10, which gets 500K in. Side note, what I like to show sometimes here is an illustration that stops funding after 10 years. A lot of people like the idea that I've spoken with over the years, like the idea of getting $500,000 in and then stopping, let it ride over time, sit and grow the cash value. You'll see the death benefit take a hit initially and then recover over time, but you can stop. That's my long-winded explanation there. Anyway, what do you see here? Break even, very close to year 6, just about there. Year 7, you're cash positive. So this looks good. Is it optimal? It is not. The reason why you're funding 50K, where you've got that 100K MEC limit, that's not the main reason it's not optimal. The main reason it's not optimal is you've got that base premium, 9K, it's about 10K with that plus the term rider. The ability to 10x that and go up to 100 a year, and we're not doing that. We're funding 50% of our max. There we go. How's that look? All the same policy, by the way. This is showing what it would look like if you do add more money. So there's 100K per year because you're funding your minimum and then dropping more funds into PUAs on a yearly basis. There's a cool what if to say if you wanted to stop after you get 500 in, you can, just to show someone that they can do that. And remember the consideration there is 100K realistic. If it's not, I would look at a lower minimum here. So we actually put that together. And if we look at the illustrations, what you'll notice is you've got much lower minimum premiums here. You'll see much lower death benefits as well. But what do you notice here? Let's look at the 50K because we looked at that, and the 24K actually. The 24K a year we looked at with the policy where you had the 12K minimum. When was the break even? Do you remember that? It's about year 9. What's it here? Just about year 5. How about the 50 for 10 years? Just about year 5 as well. Here, you've got a minimum premium plus term rider of about 5,000, whereas over here, it's about 2,400. So what we did was scale down the minimum, which also scaled down the maximum. So this has a 50K max. This one has a 24K max, but we're scaling down the minimums and the maximums in these particular cases. So the last thing we would show him, that we showed him, was how to use the policy with respect to loans, which I would check out any of our loan videos that go through that, because we are going to stop at this video. Please let us know your thoughts and which option would you select? Would you go with the policy with the 100K maximum, where you can commit to $1,000 a month, then go up to 100K per year? Or would you start more conservative with a 24K max or a 50K max and then ease your way into it, maximize that policy, and then once you're comfortable, start a new policy that's much larger perhaps. So I do hope that you enjoyed this. I hope this helps, and we'll see you in the next video. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.